Hello, everyone. Welcome to today's St. Thomas Alumni webinar. We're here with David Carlson speaking about student loans. David, take it away.
Welcome, everyone, to our Student Loan Repayment 101 webinar. Really grateful to be here. Both my wife and I are St. Thomas alumni. I went to St. Thomas for my undergrad, was a finance and political science double major. My wife graduated within the past couple of years with her master's in counseling. So really enjoyed our time at St. Thomas. Think it's a great school, and definitely thanks to St. Thomas for making space for these sort of resources for alumni, and thank you to Morgan and everyone else who pulled this together. There's a lot that goes in behind the scenes. So a little bit about me. I'm David Carlson. I started the blog youngadultmoney.com about 7 years ago. And with this site, I'm really focused on helping people in their 20s and 30s make more, save more, and live better. And inevitably with this site, something that came up over and over again was student loan debt. Either you or somebody close to you likely has student loan debt. And yeah, it just seemed like the right topic for my book. My second book was Student Loan Solution, 5 Steps to Take Control of Your Student Loans and Financial Life. Really proud of this resource, and I think it really embodies my approach to student loan debt. Some personal finance professionals will say you need to pay every extra dollar towards your debt. You need to cut your budget to bare bones and just kind of get by on that until your student loans are gone. But the approach I take, as you can see here, is a more balanced approach. I think you need to take your individual situation into consideration. So when you're thinking about your student loan repayment strategy, you can't do that without thinking about whether you have an emergency fund, do you have higher interest credit card debt, what career you're pursuing, do you have options for things like loan forgiveness. Really just taking all that into consideration when you think about your strategy. So today we're going to be focused on the first 2 steps of my book. Really focus on your student loans. So what type of loans do you have? Why does that even matter? And then how does that come into play with your options with income-driven repayments, opportunities for loan forgiveness, all of those sorts of things. And we'll also talk about some of the hot topics like loan consolidation, refinance, some of the other topics such as subsidized versus unsubsidized, and all of those buzzwords you hear when you think about student loan debt. Before we get too far into it though, I want to recommend that you save this link, youngadultmoney.com/SL. So at this link, you're going to have access to additional resources. We have a cheat sheet there. It's a 1-page front and back kind of overview of the different topics that we talk about throughout this presentation. And there's also additional resources there. So one thing we'll talk about is what to do if you fall behind on your loans or if you fall into default. So there'll be additional blog posts and resources there. Besides that, we'll also have links to external sites. So I'll talk a little bit about studentloans.gov and the resources that are available there as well. So you don't have to scramble to write down those links. You can just go to this link and get all of those resources. So let's start by talking high-level types of student loans. So we got federal and private, with the overwhelming amount of loans being federal. So about 1.5 trillion of federal loans and about 100 billion of private loans outstanding. So the major things to think about when you're comparing these two is the benefits that come with federal loans. So when you have a federal loan, you have access to loan forgiveness opportunities, income-driven repayment. You can put your loans into forbearance and all of those sorts of benefits, which we'll talk about more throughout the presentation. And then when you think about private loans, they're owned by a private bank. So you're not going to have those same benefits as federal loans. And this is something key to keep in mind, especially if you are thinking about refinancing or if you're looking at the opportunities available to you. And again, with private loans, you're going to want to prioritize those over your federal loans because federal loans are so much more beneficial, I'd say. And then just briefly, I'll mention there are some other types of student loans. Minnesota actually has their own student loan program, so especially the audience listening to this, you might have some of those Minnesota student loans. And then there's a few others such as Perkins loans as well. So the first step in taking control of your student loans is to understand your loans, and that starts by finding your student loans. So you can go to the National Student Loan Data System to get all of the information about your federal student loans. And there's a link on the screen, but again, if you go to youngadultmoney.com/SL, you can access that site. And at this site, you can pull all sorts of information, interest rate, who's the servicer for each of those loans, when it was taken out, if there's any accrued interest, all of that good information. And then looking at some of the other loans, such as private loans, more likely than not, the bank that has those loans has been kind of hounding you with communications. So you probably know who owns your private loans. But if you don't, you can go to annualcreditreport.com and pull your free credit report there once a year. That's going to have your private loans, your federal loans, and all of your debt actually. So if you have a mortgage, if you have a car loan, all of that will be available there. And then with those private loans, you're going to want to get access to their online dashboard where you're going to find additional information such as interest rates and other details around that. With all that information, I recommend creating a student loan snapshot. At that link I've been mentioning, you can download our free student loan spreadsheet. There's a screenshot here of part of that student loan tracking file. And this started as something that my wife and I use just to kind of put both of our loans together and see, okay, how much do we have between the two of us? What sort of different types do we have? And what sort of opportunities are available to us based on that information? So if you haven't done this in a while, you might want to take a deep breath, especially if you've been in grad school or your loans have been in forbearance, because that accrued interest, which is basically interest that builds when you're not paying your loans, can really build up over time. So let's say you took a loan out when you were freshman year of undergrad. You start to build interest on that throughout those 3, 4, 5 years that you weren't in repayment. So take a deep breath, know that there's options available to you no matter how many loans you have. And with this spreadsheet, there's also a bunch of other tabs in the file. I really kind of built it out for the book. There's tools and calculators in there. There's information on refinancing. There's an income-driven repayment tool that we'll go over in a little bit here, where you can plug in information and kind of see how different strategies would play out for you. Looking at federal student loans in a little more detail, there's 2 different programs that make up federal student loans. Federal Direct Loan Program, which is still active today, as well as the Federal Family Education Loan Program, which was discontinued in 2010. So a lot of people listening to this might have those FFEL loans. It does come into play if you're looking at stuff like income-driven repayment, public service loan forgiveness, really important points that we'll go over when we hit those topics. But as you can see, they both have subsidized and unsubsidized loans. They got different loans for parents, for grad students. So a variety of loans available to you that you might have. Looking at subsidized versus unsubsidized, I mentioned it a little bit already, but the major difference between these types of loans is that with subsidized loans, interest only builds when you enter repayment. So let's say you took out a subsidized loan freshman year of college. If it was subsidized, you're not going to be building interest throughout those 4 to 5 years. If it's unsubsidized, as I mentioned earlier, there's going to be interest that accrues all throughout that time period. And then where it really hits you is if you head off to grad school and put that unsubsidized loan back into deferment, because then you got even more interest accruing. So this is really how some people go from taking out $40K and seeing that balance build over time, especially, again, grad students who enter a period of deferment. So when we're thinking about federal loans, subsidized is definitely better than unsubsidized. And then going back to private loans, federal loans are better than private. So I mentioned deferment. Looking at deferment and forbearance, very similar. They both allow you to temporarily stop making payments on your loans. But the major difference is that with forbearance, interest is accruing on all of your loans. So with those subsidized loans, you're not getting that benefit of interest kind of being on hold and not building, which is why when you're comparing these two options, deferment is definitely preferable. And there's a bunch of different eligible deferments, such as in-school, which virtually everybody has taken advantage of. But there's also stuff like economic hardship deferment. So deferment better than forbearance. Unfortunately, forbearance is a lot easier to take advantage of. It can be as simple as 5-minute phone call with your loan servicer, giving reasons like I'm focused on other financial priorities, or I'm in a weird time in my life and I need to put my loans in forbearance. But I would encourage you to look at deferment instead. And if it's not an in-school deferment, it's usually better to move directly into an income-driven repayment plan. That way you're making progress towards paying off your loans. It's based on your income, so even if you have a lower income at that time, the payments will be reasonable, and you're working towards income-driven forgiveness, which is over the course of 20 to 25 years. And I want to talk briefly about what to do if you're behind on your loans. 1 million new borrowers a year default on their loans, so it would be no surprise to me if some of the people listening to this, maybe your situation is you've hit a hard patch and you have gone into default. First of all, what is default for those listening? It means that you have been more than 270 days behind on your loans. And typically, loan servicers take about 90 days to report this. So you could be closer to a year behind when you officially are reported as in default. So what happens when you're in default or not in default as far as the path to making your loans current? It's going to depend on which scenario you fit into. It's much easier to make your loans current if you're not in default. So if you're a few months behind, I really encourage you to look into what you have to do to make those loans current. It's very difficult to discharge student loans in bankruptcy. They're kind of a unique type of debt in that sense. So the faster you start making on-time payments, the sooner you're making progress towards that income-driven loan forgiveness, which is really beneficial. So if you are in this situation, I won't go into any more detail now, since it might just be a small subset of people listening. But again, youngadultmoney.com/SL, there's a blog post that's taken basically directly from my book, Student Loan Solution, that will walk you through the options available to you. So let's talk about loan consolidation, which is another kind of hot topic, a buzzword with student loans. This basically means you're taking your federal student loans and combining them into one. So instead of having 12, 15 student loans spread across 3 or 4 loan servicers making all these payments, having to keep track of all those, you have one loan with one loan servicer, one interest rate. Really simplifies things. One thing to keep in mind, though, is that this doesn't make your student loans any cheaper. It takes the weighted average interest rate on all of your loans. So if you had one really high interest rate and a bunch of low interest rate, you're probably going to have an interest rate that is more towards that lower end, or vice versa. If you have one that's low and a bunch that are high, it's going to take the weighted average of all that. So it doesn't make your loans any cheaper in that sense. It is one way to exit student loan default is through consolidating your loans. One thing that I don't like about this is that you can't strategically repay higher interest loans first. So once you go through with consolidation, you can't undo it. So if you decide, oh, I wish I would have been able to pay off that higher interest loan first, there's no going back to that. But if you don't go through with consolidation, you can pay off that 8% loan before you tackle the 4 or 5% loan. So I think that is one benefit and one way to keep your options open. It does also have a negative effect if you are pursuing student loan forgiveness, because it is going to reset your clock. So loan consolidation, it creates a brand new loan. The loans that you had previously no longer exist. So let's say you made 5 years worth of payments towards public service loan forgiveness, and then you consolidate, well, you're back at square one because those loans you're making progress on, they no longer exist. So something to really think about before going through with it. It is nice to simplify things, but there may be other impacts by going through with that approach. And I want to kind of compare this to student loan refinance. Student loan refinance has become huge recently. There's a lot of startups and banks that are offering this product, and it's for a simple reason. It's a simple product with a very clear value proposition. The borrower saves money, the bank increases the number of loans on their book and are able to leverage that. So very simple, not that difficult for the banks and startups to offer. So that's why you're seeing more and more advertisements for this. Me especially, like when I'm on social media, I see tons of ads for the different refinance companies. So I think it's important that anyone considering this know the benefits, the pros and cons of doing it. Like I said, brand new loan with a private lender. So there's not much risk if you have a private loan and you're refinancing, because you're not going to lose those benefits that came with your federal loans because you already don't have them. But with federal student loans, you will lose those benefits such as income-driven repayment, loan forgiveness, and the like. So you really want to think about it before you go through with it if you have federal student loans. But with those private student loans, it usually makes sense. So some of the benefits of refinancing, lower interest rate is the big one. If you weren't getting a lower interest rate, you wouldn't go through with the refinance. So super beneficial. We'll go over an example in just a minute that shows very clearly how this can save you money. It's only available to qualified borrowers. So if you don't have that solid credit history and you don't have that high credit score, you may not be eligible. Quite a few applicants actually do get rejected for having not a good enough credit history. So if you're not eligible today, but you still want to take advantage of it, focus on improving your credit score and working towards that path. And even if you do refinance, I tell people it doesn't hurt you to go look at rates every 6 to 12 months because your credit might have increased, your income's considered. So if your income has increased, it might be beneficial for you. And you might be eligible for refinance. So let's look at a simple example here of student loan refinancing that shows clearly what the benefit is. So Rob has $50,000 in student loans. He's got a weighted average interest rate of 7.5%, just to keep it simple. So looking at the top line here, he's been making about $600 a month in minimum student loan payments over the course of 10 years. He'll end up paying about $21,000 of interest based on that loan. So if he's able to take advantage of refinancing at, say, 5.5%, which is the next row, he's going to save about $50 a month in cash flow, and he's going to pay over $6,000 less in interest. So pretty material savings, and $50 might not seem like much, but as you can see, over the course of 10 years, it really does build up. So you can use that $50 extra to pay down credit card debt. He can invest it in his retirement account, build up an emergency fund. A lot of different options available to him. And then where he can really benefit, and this is something that a lot of refinance companies will highlight, is if he contributes more than the minimum. So he refinances at 5.5%, and he makes $750 a month in payments. Not only is he going to pay over $11,000 less in interest compared to the original loan we were comparing, but he's also going to get rid of his student loan debt in 6 years and 8 months. So this is really attractive to some people who can afford their student loans and want to kind of aggressively pay it down. As you can see, refinancing and putting extra towards his debt really benefits Rob in this situation. As I was mentioning earlier, though, it's really important to consider whether refinancing makes sense. And one thing that does concern me is that loss in federal student loan benefits that people might not be thinking of. So first of all, if you're struggling to afford monthly student loan payments, don't use refinancing as a way to free up cash flow. Look at some of the benefits of federal student loans and take advantage of those, such as income-driven repayment for one. Don't refinance if you're struggling. And also, if you want or need to keep those federal student loan benefits, maybe your future career is unsure. Maybe you work in a career where there's a lot of turnover or contracts kind of come and go. You might want to hold on to those federal student loans just in case something changes in your career or your financial situation. But who should consider refinancing? Private student loans. There's really not much difference between the different private student loan offerings. So if you can get a better interest rate, I usually recommend people look into that. You should be able to afford your monthly minimum student loan payments relatively easy. You shouldn't be stretched like a lot of student loan borrowers are today. And yeah, you should be comfortable foregoing those federal student loan benefits. So we'll go through an example later on where somebody's going to benefit greatly from pursuing public service loan forgiveness. That's a situation where she really doesn't want to refinance because she's going to lose a big benefit with that. And I guess the last thing I'll say on this is look at your own situation. If you already have private student loans, then you already have them. So look into refinancing, maybe extending the terms of that loan. You are most likely going to have to pay it. So focusing on making that a manageable amount. First of all, working with your loan servicer and trying to see, hey, can we come up with something a little more reasonable is usually a good first step. Let's look a little bit more at federal student loan repayment options. Everyone's familiar with the standard 10-year repayment plan. That's what everyone gets put in by default, by law, once they enter repayment after in-school deferment. And this basically has consistent payments over the course of 10 years. But some of the other options are income-driven repayment, where your payment is based on your income and a few other factors. And then there's graduate and extended repayment, which I'm not going to focus on because whenever I hear about these repayment plans, it's usually in the context of somebody who regrets going onto that plan because of loan forgiveness opportunities where they're not making progress towards that. So really focusing on either standard 10-year or one of the income-driven repayment plans. So looking high level at income-driven repayment, there's 4 different plans. There's 5 broken out here, and that's because income-based repayment has different terms for new borrowers as of July 2014. So if you had already taken out loans at that point, you'd fall into the existing bucket. I have them listed out here in, I guess, most favorable to least favorable, starting with pay-as-you-earn, revised pay-as-you-earn, income-based repayment, and then all the way down to income contingent repayment. Basically works exactly how it sounds, takes your income, family size, and federal poverty level into consideration when calculating your minimum required payment. And that percentage of income ranges anywhere from 10 to 20%. And as we'll see in a calculation example coming up, that's based on discretionary income, which is a good thing and beneficial to borrowers. So the 10 to 20% might be even lower than you're thinking. And then again, talking about loan forgiveness, once you get on one of these plans, you're on the path to income-driven loan forgiveness, which takes 20 to 25 years depending on various different aspects. Notably, if you have any grad school student loans that you're repaying, with a repay that will push you into that 25-year timeline. A few other things to keep in mind is they are a little bit complex. I can't go over all of the complexities in this webinar since we're not just focusing on this. But there's different things like interest subsidies, there's eligibility requirements. For example, my wife, who's a therapist, is on an income-driven repayment plan. And because of when she was a borrower for the first time, she wasn't eligible for the most advantageous plan, which is pay-as-you-earn. So she's on revised pay-as-you-earn. So there's different factors that come into play when you look at these. But in general, how I have them laid out is most favorable to least favorable. And this is on that cheat sheet I mentioned on youngadultmind.com/SL. I think this is a nice high-level way to look at the different plans and see, okay, what are the high-level characteristics? Because unfortunately, it's complicated and they're not consistent. Looking at qualifying loans, again, unfortunately, it's complicated. So we'll start with Parent Plus, that first column. So I don't have X in any of the boxes because Parent Plus loans are not eligible for any of these income-driven repayment plans. So unfortunately, parent borrowers are left out in the dark. There is one way to get them onto income-driven repayment, and that is through a direct loan consolidation. The problem with that is if you pull even one Parent Plus loan into a consolidation loan, that means your only option is income contingent repayment. So ICR, which is by far the least advantageous income-driven repayment plan. So I generally say stay away from consolidating those Parent Plus loans and kind of deal with them separately. Because otherwise you're only eligible for ICR. If you've already gone through with this, obviously take advantage of ICR if you need to. If you haven't though, I'd recommend keeping those separate from the rest of your loans. All other direct loans that are outside those scenarios I just described are eligible for all 4 income-driven plans. And then FFEL loans, which a lot of people still have, are only eligible for income-based repayment. If you do consolidate them with other loans, they're eligible for any of the income-driven repayment plans. But again, be careful with that Parent Plus loan. Let's look at an example of income-driven repayment. So this is a screenshot from that student loan spreadsheet I referenced earlier. You can plug in your numbers there, and stuff like the federal poverty level will be populated, discretionary income calculated, and so forth. So Rachel has $50,000 of direct subsidized loans and $35,000 of unsubsidized loans. They're at 6.5% interest rate on all of the loans. She's single with no dependents, resides in the state of Indiana, and has a $40,000 AGI. AGI is really important, which means adjusted gross income. And this is actually where the law helps people who are moving into income-driven repayment, because AGI, any dollar that you put towards a tax-deferred repayment plan or a tax-deferred plan such as a 401k, 403b, HSA, standard IRA, all of that is excluded from the AGI number. So there's a huge incentive, especially let's say you're working towards public service loan forgiveness, huge incentive to put money into those accounts to lower your AGI, which in turn lowers your discretionary income and the amount that you're putting towards your loans. So with Rachel, she's got $40,000 as her AGI. Federal poverty level is calculated at 150% for most of these loans. And this is where ICR hits you. They only give you 100%, so the discretionary income calc is higher. And as you can see on the bottom section, 20% is the ICR factor. So she's going to be paying $464 under ICR. Under the other plans, anywhere from about $180 to $270, which is significantly less than the $965 that she would be paying on the standard 10-year repayment plan. And if you just think high level, okay, she's making $40,000 as her AGI. $1,000 a month is a pretty big lift for her. She'd be living pretty low standard of living, probably not able to put money into an emergency fund or a retirement plan or anything like that, which is why I say you got to take your individual situation into consideration. Maybe she could make those $1,000 of payments, but does it really make sense for her? In my opinion, it makes more sense to go on that income-driven repayment plan, start saving, start investing. She'll feel a lot better with that liquid cash in her savings account and then with those investments building than if she's making that $1,000 a month payment. So with that, let's talk about applying for income-driven repayment. You want to go to studentloans.gov. I got a screenshot of the paper form on here, but it's really easy to go through the online option. Like I said, my wife applied for income-driven repayment after getting her master's in counseling. Really easy to go through the process and be set up. I do encourage you, though, to learn a little bit more about those different income-driven repayment plans. You can just have them put you into the most advantageous plan, but it's better if you feel comfortable with the different plans and what the different amounts are. You should be able to actually verify once those loans get put onto one of the income-driven plans, did they actually do it correctly? So I was able to look at the required payment for my wife's loans, bounce them up in the spreadsheet. Okay, does it add up? And it did actually add up appropriately. There's been a lot of complaints against loan servicers. So it's important to really do your homework, understand what you're doing, and check their work. With income-driven repayment, they're obviously basing this off of your income. So you need to recertify every single year. Otherwise, let's say you're making $30,000 one year and $60,000 the next year, you would just not recertify and just keep making payments on the $30,000 a year, which the federal government says you can't do that for obvious reasons. So you're required to recertify every single year. And failure to do this, you could be kicked off your income-driven repayment plan, put onto the standard 10-year repayment plan. Any accrued interest could capitalize. And what I mean by that is, let's say you move on to a plan like Rachel did, where she's paying $182 instead of almost $1,000. There's a chance that she's not covering off on all the interest on those loans, let alone any of the principal. So that interest does accrue. And if you exit the plan, all that accrued interest will be added back to the principal, and your balance will be higher on the standard 10-year repayment plan. And finally, there's some controversy over this, but your loan forgiveness clock could reset. There's some nonprofits and other groups that are saying, yeah, if you get kicked off of the income-driven plan that you're on, you're basically starting over at square one on that 20 to 25-year path. Others will say, no, if you look at the regulations, some of the payments will count in certain situations. But for me, I don't like any of the gray space, so I definitely recommend get on the best income-driven repayment plan, stay on that plan, make on-time payments, and recertify every single year. Going back to Rachel's example, studentloans.gov also has a calculator. And the nice thing about theirs is they actually show you how much you'll pay over the life of the loan. And this assumes that your income increases 3% every single year. So it's kind of hard to see, but on that revised pay-as-you-earn, or actually we'll look at pay-as-you-earn in the middle of the page, Rachel would pay about $86,000 over the course of 240 months compared to $116,000 over 120 months on the standard 10-year repayment plan. So she'll never pay more than $605 a month based on this calculation compared to $965 every single month. So that alone frees up a lot of cash flow to hit on some of those other personal finance basics. I know I sound like a broken record, but emergency funds so important if you have student loans, starting to invest for retirement, and all of those things. And the reason why it stops at 240 months is because she would achieve income-driven loan forgiveness at that point. And as you can see, revised pay-as-you-earn in the middle, they calculate over the course of 300 months because they assume that she has a grad student loan. So this is a useful tool, studentloans.gov. Definitely recommend throwing your numbers in there. It's a little bit limited in the sense that it does have that 3% increase factored in. You can't really adjust what your income's going to be, whether you add any dependents, anything like that. But it's a complex calculation, so it's better than nothing. Let's talk a little bit more about loan forgiveness. I've talked a lot about income-driven loan forgiveness, and I'll go over that high level in just a minute one last time. Public service loan forgiveness is really the holy grail of loan forgiveness because you only have to make payments over the course of 10 years or 120 qualified monthly payments that do not have to be consecutive. You can make 5 years worth of payments, go work for a for-profit for a couple of years, go back into an eligible employer, and get right back onto that plan and start making qualified payments. So we'll definitely talk about that a little bit to round out this webinar. There has been a lot of negative press about it, and there's reasons for that. So this is the first batch of people applying for it. As I mentioned earlier about the repayment plans, some people have that extended repayment plan. Well, that's not a qualified repayment plan for public service loan forgiveness, so none of those payments counted. Same with FFEL loans. That is not eligible for PSLF, so you need to consolidate those into a direct consolidation loan to make them an eligible loan. But we'll get into that a little bit more in just a minute. And I do want to mention these aren't the only two types of loan forgiveness plans. They're just what I think are the two most important ones, the ones that the widest number of people will be eligible for. There are other forms such as teacher loan forgiveness and some obscure type of loan forgiveness plans such as, let's say you're an MD and you're practicing medicine in rural Texas. You might have access to 50 to 100K of loan forgiveness each year for 2 years. So each state has different plans like that. It might be worth looking into. But again, the first two are really the major ones that are going to come into play. With income-driven loan forgiveness, 20 to 25 years of payments. Mentioned a little bit earlier, but stay on the same income-driven repayment plan. That kind of takes some of the gray area out of it. It is nice that with this plan, you don't have to submit any paperwork to get the loan forgiveness. The Department of Education kind of takes that task on. The bad thing about that is whenever there's gray area, I get a little bit nervous because you don't have any control over the application or when you think you're eligible. So if possible, stay on the same income-driven repayment plan. Make those on-time payments over 20, 25 years. Recertify every single year. A big difference between this and public service loan forgiveness is that forgiven debt is taxed. And what that means, a lot of people will say, what does that mean? What do you mean by taxed? So let's say you reach year 20 and you get $250,000 of loans forgiven. And that's going to be both the principal and the accrued interest on those loans. That $250K is going to show up as taxable income on your income return. So that's kind of difficult because a lot of people who are taking advantage of this aren't going to be in a financial space to actually pay taxes on $200K plus of income or whatever the amount is unless they've really prepared for it. And I don't think enough people are aware that they need to be setting aside money. So keep that in mind if you work down the path of income-driven loan forgiveness. Building up your savings, investments, and not just retirement investments, but investments that you can sell to pay for this tax bomb, as some of us call it, is really important. So that's kind of the main features of income-driven loan forgiveness. If we jump back to studentloans.gov and look at an example of public service loan forgiveness, you can punch in all of the information for your loan, similar to what I did for Rachel in this scenario, and you can click a button that says factor in PSLF. And this is where you can really see the benefits of public service loan forgiveness. Rachel is going to pay as little as $30K on most of the income-driven repayment plans over the course of 10 years versus the $116K that she would pay on the standard 10-year repayment plan. And this is the big reason why I say don't be scared away from PSLF, because for some people, there's a huge benefit in pursuing it, in sticking with it, and making sure that you're checking all the boxes. So looking at the $116K versus the $30K, not only is she going to pay just $30K, she also can be strategic about it. She can max out her 403B. She can put money in a standard IRA. Even HSAs, which more and more people are having, which are health savings accounts. even those are tax deferred. So every dollar you put in there is a dollar that's not going to be factored into your payment calculation. So the name of the game with PSLF is to minimize your payments, maximize forgiveness, and then do those things so that you feel more comfortable, such as setting aside money for savings, investments, and you'll feel a lot better about the situation you're in. Because it can be scary pursuing a program that has had so much bad press, but the fact that you're even listening to this presentation is a good sign. It means that you are interested in the information that's going to help you pursue it, and you want to learn more about it. Looking at some of the fine print on this plan, and this is where I get into some of the complicated aspects of it, where people get tripped up. Only qualified plans, so 10-year standard repayment plan, as well as the income-driven repayment plans. And the reason why that 10-year standard plan counts is, let's say you are a nurse practitioner working a couple of years for a nonprofit employer. You're going to be able to take advantage of those 2 years where maybe you were really stretched, but you were making those on-time payments over the course of 10 years. You can take credit for that and kind of retroactively claim that. But obviously you want to move on to an income-driven repayment plan because otherwise your loans will be gone after 10 years. Has to be qualifying loans, so only direct loans. FFEL loans are not eligible, and this is why a lot of people have been rejected from public service loan forgiveness recently. And some people, they have legit claims where they're saying, they call the loan servicer said, yes, you are eligible for it, but really they had FFEL loans. So a lot of lawsuits, a lot of focus on this from a public policy perspective recently. And then finally, qualifying employer, working full-time for a qualifying employer or working for 2 or even 3 employers that make up about 40 hours a week. Ideally, it's just one employer because it's easier with the paperwork. But this is going to be government organizations, any level of government. One important distinction is not a contractor for a private company that works on government contracts. It has to be directly employed by the government. And then 501c3 not-for-profits is the other one that you can work for. And then finally, there is this gray area. And like I said throughout this presentation, I don't really like gray area with this because it's already complicated enough. And there's already enough people getting rejected, enough appeals where this can be tough. But if you're in that situation, yes, it's better than nothing. But other types of not-for-profits, so not-for-profits other than 501c3s, whose primary focus is on certain types of qualifying public services. And there's a list that you can find on studentloans.gov. It's about 13 different areas, but that has to be their primary focus. And I don't really like that. I like when it's straightforward. Government employer is the easiest. 501c3 not-for-profits, really great as well. And how you qualify for forgiveness when it's all said and done is 120 on-time qualified payments. So you got to fill each of these buckets, be working full-time, and the payment has to be made on time. Does not have to be consecutive. So unlike that income-driven loan forgiveness, where you want to keep making those payments month after month after month, you can start and stop this as you see fit. And this can be beneficial, especially if somebody has a lot of undergrad debt. They can start making payments on that if they work a couple years before going to grad school. Go to grad school, leave grad school, pick off right where they left off, already have some progress made on those undergrad loans. So to make a complicated program simple, here's 5 steps, very high level of how to pursue public service loan forgiveness. Make sure you are qualified, and that's by going through each of those buckets that we talked about. Apply for an income-driven repayment plan so that you're not on the standard 10-year because that's not going to benefit you if you're pursuing PSLF. And then something I haven't mentioned is the PSLF employment certification form. And this is, again, where some people are struggling and running into issues when they're applying for their final loan forgiveness. There really is no requirement that you submit this form at any time when you're making qualified payments. But FedLoan, the loan servicer who kind of marks payments as qualified or unqualified. They're only going to mark stuff as qualified when they get this employment certification form and they vet that employer and make sure that everything aligns to expectations. So what I recommend people do, at the very minimum, resubmit that annually when you submit your IncomeDriven repayment recertification form. So do that every single year, and honestly, you can do it every 6 months just to keep building up that qualified payment number. And I think that this program, if it's not already, it's going to get overloaded. There's going to be a lot of demand for it, especially as people start seeing some of those big benefits they can experience from pursuing it. So submitting that employment certification form is going to become even more important to do regularly, because you don't know how long it's going to take FedLoan to get back to you. It could be 3, 4, 5, 6 months before they mark anything as qualified. And then if they botch it, if the paperwork had some sort of error, then you just have to kind of go back and resubmit it and wait another 3 to 4 months or whatever the time period will be. So yeah, again, it's kind of a pain in the ass, the program, but at the end of the day, it can really benefit you. So after you make those 120 qualifying payments, submit the final application for forgiveness. And when you do that, do not stop making payments, because the last thing you want to do is have a required payment that you don't pay because you're like, oh, well, I already made all the required payments, I put in my application. You don't want to not make that payment and then go into bad standing with the Department of Education, because they're not going to grant loan forgiveness if you're not in good standing. Beyond that, though, you also want to keep working for an eligible employer. And again, this program is going to get overloaded, so you may have to stay with that eligible employer longer than you want to. But don't assume anything until you see all of that debt forgiven in your account. So a lot of people have had issues with this program. Super important to be as educated as possible if you're pursuing it. And you can reference resources, like I said, on my website, Young Adult Money, or my book if you really want to get into personalizing your approach to student loans. So that's kind of all that I have for this presentation. I know I went over a ton of information. Some was probably relevant to your situation. A lot of it probably wasn't. Like if you just had private student loans, you really got to focus on that. If you don't work for an eligible employer, PSLF might not be something you care a lot about. But pick and choose the things that are relevant to you and go and learn more about it. So youngadultmoney.com/SL, download the cheat sheet. The book has all this information and more, especially when we talk about stuff like income-driven repayment, where there are benefits like interest subsidies and things like that that you can learn more about and take advantage of. If we don't answer your question today, highly recommend you send it to me at info@youngadultmoney.com. Happy to answer any specific questions. This is a complicated topic, and I'm sure everyone listening hasn't spent hours looking at the ins and outs of the different loans and loan programs. And if it's something you think others would benefit from and you're on Twitter, send it to me at DavidCarlson1, and I'd love to answer your question and share it with everybody else. And then if you want to connect on Instagram at David_Carlson, you can send me your questions there as well. So I think we have a few questions queued up, so we'll see if I have answers for them.
Yeah, like you said, a ton of information to take in a short period of time. So I'll start pretty broad here with a question that says, I've got quite a few loans between public and private lenders. Would you suggest I see a financial advisor to help me? And how can I tell if they have experience with student loans specifically?
That's a great question. I'll tread carefully with my answer to that. I think one issue is that the CFP exam doesn't actually have any student loan questions on it and no content. So somebody could theoretically become a CFP without knowing any of the detail I just talked about. So I'd recommend, I don't want to say don't talk to CFP, but I think it's really important to do your homework so you kind of understand the basics. Honestly, spending a few hours can really help just get that base knowledge. And then having that base knowledge can kind of help you vet your CFP that you're going to. And I would say ask them really pointed questions of how many borrowers or how many clients have you worked with who are student loan borrowers? How much debt did they have? What do you know about income-driven repayments? All those different things. So asking a ton of questions is helpful. And don't feel afraid to walk away from a CFP if they don't have enough background on this. And I'm pretty paranoid about student loans, so I'd still say look into it yourself.
Okay, one more question about kind of that public versus private loan scenario. What tips might you have on sort of shopping for loans as a student? Should I just take all the federal loans that are available to me, since it sounds like generally they're sort of the safer option?
Yeah, so when looking at a student who's taking out loans, I think going through some of the things that we walk through in the presentation is helpful. Subsidized student loans, federal ones, definitely the best option. Get as many of those as you can. Unsubsidized being the second best. More and more people are taking out private student loans. My wife and I had some private student loans when we graduated from undergrad, which we definitely prioritize over the federal ones. So it's kind of tough as a student because you got to take out what you got to take out to get through college, and it's definitely been shown that finishing your college degree is a huge benefit. So some people might get a little bit worried about, oh, I've taken out too many, I want to stop taking classes for a while and kind of figure this out. But finishing is kind of the top priority. So if you're already down that path, that's the way to go. And yeah, federal loans over private loans.
Yeah, and on that point of sort of adjusting your schedule as a student, I mean, is it more, are there benefits to maybe taking 3 classes per semester instead of 4 and extending that time as a student, or is it better to just get through it, get that degree, and start paying those loans off as soon as you can?
I think the one thing that impacts that is the unsubsidized student loans. So if you're taking longer to graduate and you have a lot of those, and private loans as well, they're going to be accruing interest that entire time. So the faster you can finish college, the faster you can start repaying. There obviously are other factors that go into whether it makes sense to, go through college as quickly as possible. You could argue somebody who takes a bunch of PSCO class in high school, finishes college in 2 years, may not be quite as prepared for the workforce as somebody who took at least 3 years, if not 4 years or longer, to complete their degree. So there's a little bit of subjectivity there.
Okay. And one last question kind of in this area. What can I be doing as a student to set myself up for a better repayment situation after graduation?
I think the toughest thing recent college grads run into is, number one, not knowing how many loans they have. So if you haven't started repayment yet, this is a really great presentation because you're probably in a grace period for another couple months, depending on when you're watching this. But yeah, I think just learning as much as you can about how much loans you have, what type of loans they are, what options are even available to you, because I've seen a lot of people, they might add up all their loans, again, especially after grad school, and they have 100K, 200K more, and they just don't know what they're gonna do. But some of the options, such as income-driven repayment, or, okay, with my private loans, I'm gonna look for a lender that will give me a 15-year term instead of 10, which isn't ideal, but also if it's reasonable payments, it may be better for your situation. So weighing all these options and getting ahead of it so you don't just get hit with a big student loan bill. And I think that actually is driving a lot of the default rates as well, where people open their student loan, they laugh or cry, and then kind of throw the bill away and say, there's no way I'm paying this. Are you kidding me? I can't afford this. But if they had known going to the income-driven repayment plan was starting them on a long path, but still a path to loan forgiveness, I think they might have approached that bill a little bit differently.
if I'm already on track to pay off my student loans and can make the regular payments, it sounds like it's not beneficial to consolidate those loans. Is that correct?
Yeah, consolidating your loans doesn't make them cheaper. It just makes it simpler where you just have one payment. So it's all about simplicity. In some cases, not in the example that this question comes from, but in some cases, like the FFEL loans, it does make sense to consolidate them to get them on those income-driven plans, the more advantageous ones, and working towards public service loan forgiveness. But if you're already making payments, you got them on auto payment, you can afford them. The only other thing you could look into is potential refinancing. But even with that, you could just say, I'm not going to mess around with that. I'm just going to keep them on auto payment, and you'll be well on your way to paying them off on that standard 10-year repayment plan.
One thing you touched on in the presentation was that balance of building an emergency fund with paying off your student loans as fast as possible. What kind of tips do you have for sort of walking that financial tightrope? And additionally, is there sort of a standard percentage of one's income that they should be dedicating to their student loans, if possible?
Yeah, with the emergency fund, I keep bringing that up because I think those with student loans, they really need to protect themselves because they might stay in a job that they hate or that honestly can be like bad for their mental health, things like that, if they don't have that cash reserve to be able to leave if they need to. And even in some cases, if they're being harassed at work, people might stay in that situation if they don't have any cash reserves and they need to make their student loan payments, pay their bills. So I'm big on that emergency fund. If you read the book, we call it an F-off fund because basically you need that cash set aside to be able to make the moves that you need to make if you're in a bad situation. But going beyond that, the way to actually build an emergency fund, if you don't have enough cash flow, it's just not going to happen, and it can feel a bit insurmountable. So that's why I'm so big on the income-driven repayment plans, because that really does cap your loans and frees up quite a bit of cash to contribute towards that emergency fund. And I think a lot of people, when they think about income-driven repayment, they think, oh, well, I don't want to be paying my loans for 20 years. Doesn't mean that you have to be on that plan forever. You could build up your emergency fund. You might feel a little bit better about your cash flow and start making extra payments or even move back on the standard 10-year. So some tips would definitely be, first of all, looking at your income and expenses and seeing what opportunities do I have to increase my income at my 9-to-5 or through a side hustle. And then looking at your expenses and thinking about what you care about. Unlike some people in the personal finance space, I do think you should sometimes indulge yourself and know what your priorities are, know what you care about. Don't totally, deprive yourself of everything, or it's just unsustainable and you're not going to make it to that student loan balance zero anyway. As far as percentage towards student loans, I think the income-driven calculation is a good guide where ideally be 10%, 15%. You could contribute more, but I definitely think people with student loans need to be saving and investing more. So you want to divert as much as you can towards those activities while repaying. So taking that balanced approach.
I'm part of the group whose public student loan forgiveness was messed up. Do you know of any local groups I can work with to help figure out the issues with my account?
I don't know any local groups off the top of my head. If you want to reach out to me, I can kind of give you the resources that I have on the side, but I don't know any local groups off the top of my head. I would say one thing that has gone into effect is a relief bill, first come, first serve, for those who had the wrong repayment plans. If you had the extended repayment plan, you may be able to get public service loan forgiveness. And that's first come, first serve. And it actually is kind of tough to get because you first have to, even if you know you're going to be rejected for PSLF, you have to submit the application, get rejected, and then apply for this additional relief. So definitely go to the resources page that I referenced earlier, youngadultmoney.com/SL. There's stuff on there about it. And that is kind of the big way to find relief. The tough thing is if you have FFEL loans and you got rejected, as of right now, you do have to kind of start over, consolidate those loans, move on to, consolidate them into direct loan, and then move on to that income-driven repayment plan. There may be additional relief that comes down the road, and there's been a lot going on in the public policy space. This is all focused on, as of today, these are the conditions that we have to work with. They may roll out another relief fund for people who had FFEL loans where they can use that relief fund to tag those as qualified and get PSLF, but that's all hypothetical. It's not out there right now.
All right. That's all the time we have for questions right now. David, thank you so much for sharing your knowledge with us. Again, it's a lot to take in. I'm sure if anyone has any questions, they can go ahead and reach out to you.
Yeah, thanks for having me.